1986, if you'll remember, President Ronald Reagan was reelected to a second term of office, and he had a pretty good majority when he went in, and he said that he was going to make it a cornerstone of his second administration, major tax reform. And he said at that time, the tax system was so complicated that it couldn't possibly be any worse, and he charged Congress to overhaul the tax code. And as a result of that, we came out with these things called the passive loss rule. And they're covered on pages 40 through 43. Now remember, every member of Congress gets involved when the tax rules get changed. So 2 years later, when it came to Ronald Reagan to sign, as the president has to do, he signs. Congress drafts the law. The president signs it into law. He got a very different concept of what he originally had in mind. And he, at that time, though, was forced, more or less, to sign the bill because he had built it up and said it was going to be the cornerstone of the second administration, and he was calling it the Second American Tax Revolution, and it was touted as being the Tax Simplification Act of 1986. Well, as a result of that, we ended up with these things called the passive loss rules, and the purpose was to prevent taxpayers from investing in largely passive ventures, that is, tax shelters, solely to offset otherwise taxable income. So under the Tax Reform Act of 1986, timber income is now considered to be generated in one of three categories. Generally, losses in any one category cannot be used to offset income in another category. Strict rules apply to the exceptions. Prior to 1986, you had people that were investing in these tax shelters. Real estate was a good example, in which they would write off losses against real estate, which were mostly paper losses, and then they would carry them over against other income, and as a result, you had a lot of people that paid no federal income tax. So that's how we ended up with this. And the category, or at that time was called the basket concept. So here are the three categories. Timber that's held for the production of income, such as an investment, but which is not part of a trade or business. And prior to 1986, this is generally where we encourage most landowners to consider themselves to be, that they're investors. Category 2, timber held as part of a trade or business in which you do not materially participate. That is, one in which your activity is considered to be held passive. And then category 3, timber held as part of a trade or business in which you materially participate. That's one in which your activity is considered active. So I'm going to cut to the chase right now and say, now we're encouraging landowners to be in this third category. Timber held as part of a trade or business in which you do materially participate. The rules for deducting management expenses, property taxes, and interest charges will vary depending on which category your timber activity fits into. The passive loss rules apply to activities carried out as a business, but not to those carried out as an investment. So if you're an investor, you say, well, I don't have to worry about these passive loss rules. But let's look at what happens. The passive loss rules apply to individuals, to estates, to trusts, and to two categories of corporations, personal service corporations and closely held C corporations. And except for these two types of corporations, the passive loss rules do not apply to corporations generally. So these big corporations like Plum Creek Timber Company, for example, do not have to worry about the passive loss rules. And we're going to see why they don't have to worry about it. Also, the passive loss rules do not directly apply to partnerships and subchapter S corporations, since these are essentially flow-through entities and are not taxed in their own right. So if your timber ownership is a trade or business, it is subject to the passive loss rules. And you must determine which of two classifications apply to you and your forest property. This determination must be made each tax year. And I will tell you this, in 1986, we foresaw gloom and doom about the passive loss rules. We thought that landowners were really going to have a lot of trouble qualifying. So here are the business categories. Timber held as part of a trade or business in which you materially participate, or timber held as part of a trade or business in which you do not materially participate. Well, let's look at what happens when you're in this category that we are recommending. How are these expenses handled? Well, management expenses are fully deductible against income from any source. Property taxes are fully deductible against income from any source. Interest on indebtedness is fully deductible against income from any source. So as Martha Stewart would say, anytime you see deductible against income from any source, it's a good thing. That's what you're looking for. However, to be considered materially participating, the taxpayer's involvement must be regular, continuous, and substantial. And now that's what the tax law said. And that's the reason we were in gloom and doom for a long time, because I remember going to a number of tax conferences in which we had very austere people from Price Waterhouse and a number of other accounting firms saying their interpretation of this was that private non-industrial landowners would not be able to qualify because they had to earn significant amounts of income. They had to earn a substantial portion of their income from their timber operations based on these three words: regular, continuous, and substantial. Now remember from our Civics 101 slide, we said that the IRS interprets the law. And quite surprisingly, we ended up with a very liberal interpretation from the IRS. According to the Internal Revenue Service, you will be considered to materially participate in your activity if you meet at least one of the following tests. Well, test number one caused a firestorm of controversy when it came out. It's called the absolute test. You and your spouse participate in the management and the operation of the activity for more than 500 hours during the tax year. So if you think about that, that's 40 hours a week for 3 months approximately. So test number one is, yeah, that's a lot of activity. And I think we still have groups that are trying to get this law repealed, or this rule repealed, because these are proposed in temporary regulations. But all it is rule number one says if you do at least 500 hours, forget about it. Well, Plum Creek Timber Company doesn't have to worry about passive loss rules because they're going to automatically qualify under this rule number one. How about test number two? The do most of it yourself test. You and your spouse's participation in the management and the operation of the activity constitutes substantially all the participation in the activity during the tax year, even if only a low level of activity is all that is required. And this was the very liberal interpretation from the IRS. They said a low level of activity is okay if that's all that's needed to sustain the operation. And if you think about it, holding timberland or being a private landowner, holding your timber for sale to the timber business, there are many years in which only a low level of activity is all that's required. You're letting it grow, maybe going out and visiting the property, et cetera, et cetera. So at least in those years, you would qualify as materially participating. Then there's test number three, the 100-hour majority test. You and your spouse's participation is more than 100 hours in the management and operation of the activity during the tax year, and no other individual participates more. So this is important. If you're going to use hours and you've got a consultant forester, you want to make sure that you and your spouse do at least 100 hours, and nobody else, including that consultant forester, spend less than 100 hours out there. However, I don't recommend using this test. Then we have test number four, the significant participation aggregate test. You and your spouse participate in all of your significant participation activities, and it exceeds 500 hours during the tax year. Then it goes on to define a significant participation activity as a trade or business in which you participate for more than 100 hours, hence you can qualify under this. Even if someone else participates more in the timber activity than you do. Well, that's a bunch of bureaucracy, gobbledygook, etc. But best example I can think of is a farmer that owns farmland, is running a farm enterprise, also has a woodlot, and that farmer considers farming, maybe he's got livestock, and maybe some other business. Anyway, all those activities together amount to more than 500 hours, and he spends at least 100 hours managing the woodlot. Then the consultant that he hires for a timber sale or whatever, it doesn't matter whether the consultant spends more than 100 hours. So, come on in, Ron. But again, I know of no one that's ever used this test, because we have test number 5. The 5 out of the last 10 years test. You and your spouse participate, or materially participate in the managing the operation of your timber activity for at least 5 of the preceding 10 tax years. Now, if you remember rule number 2, in which you materially participate in those years because you're doing substantially all that needs to be done, even though only a low level of activity is all that's required, you do that for 5 years, then you get ready to have a timber sale. You don't have to worry about the hours here, because you're still going to qualify under the 5 out of the last 10 years test. And then finally, test number 6, the facts and circumstances test. All the facts and circumstances of the situation indicate that you and your spouse materially participate. The specific rules to be followed in applying this case have not been fully defined by the IRS. Our recommendation here is do not use this test. Actually, this test has been used by the IRS, in which landowners have said, I'm an investor. And the IRS says, well, according to your tax records and your previous tax returns, you are indeed in the trader business. And John's going to get into this. We're going to get into it a little bit later on. But some of the impact has been mitigated here. But anyway, remember, test number 2 and test number 5 makes it quite easy for a private landowner to qualify as materially participating. Here's some further definition from the IRS. You and your spouse will be treated as one taxpayer for determining whether the material participation test has been met. It does not matter whether your spouse owns an interest in the property or whether you file joint or separate returns. Also, if you are retired, disabled, and do not meet the material participation requirements, you will be treated as materially participating if you did so for at least 5 of the last 10 years immediately preceding your retirement or disability, whichever comes first. Surviving spouses having acquired from a deceased spouse forest property that qualified as a trader business need to only satisfy an active management test. And under this test, the surviving spouse will generally be required only to participate in general management decisions and not be required to make daily operating decisions. So the surviving spouse basically inherits the status of materially participating in this case. So because of the passive loss rules, record keeping is now even more important. At the time we thought that not only are you going to have receipts for transactions, you're going to have diary recordings, you're going to have odometer readings. We thought maybe there were going to be a lot of people trying to justify their time spent in managing the business, et cetera, as John has said. And remember that formal bookkeeping is not required. Any reasonable means is okay. And this includes appointment books, calendars, and narrative summaries. And records consist of many things, such as a timber management plan, records for business transactions, odometer readings, diaries, time recordings, and John's gone over all of this, and agendas to training meetings, such as today's agenda to this meeting, as well as membership records in business-related associations. And if your timber operations are established as a sole proprietorship and are incidental to farming activities, list your deductible timber expenses together with your deductible farming expenses on Schedule F of Form 1040. This form here, if your timber operations are a separate sole proprietorship business or incidental to a non-farm business, report your deductions on Schedule C of Form 1040. We have encouraged you to be materially participating in the trader business, and therefore you should report your forestry-related expenses on Schedule C of Form 1040. And I'm still just in this one category. So What about category number 2? Timber held as part of a trade or business in which you do not materially participate. Here is how those expenses are handled. Management expenses are deductible only to the extent that they do not exceed passive income. So you cannot deduct those expenses unless you have passive income. What is passive income? Well, that's income such as rents. It's a special type of income. Rental income is a passive income. Any payments that you receive under the Conservation Reserve Program, that is the annual rental payment, that is passive income. If you don't have passive income, you don't want to be in this category. And there were predictions early on that we were going to see landowners running out and investing in these things called PIGs, P-I-Gs, passive income generators, just so they could get in this category, and that way they could be passive participants in the trade or business. Property taxes are treated the same way, and interest on indebtedness is treated the same way. And even then, it's not so hot, to be quite honest with you. Credits attributable to passive timber ownership, such as the reforestation tax credit, may be applied only to offset taxes associated with income from passive activities. Credits not used during the tax year may be carried forward but not back for use in future years. So, of course, the credit is now going to be, it was repealed in October, but anyway, it's just another disadvantage here. And you report allowable passive deductions for the tax year on Form 8582. All right. Let's look at this category here, timber held as an investment, and this is where a lot of landowners feel most comfortable. It's where most tax preparers, if you can convince them you've got a profit motive, this is where a lot of tax preparers want to push you into. In this category, timber held as an investment. An investment is an undertaking entered into with a view to realizing a profit, but which does not involve the same regularity or frequency of activity that a trade or business would require. That's just the basic definition of investment. Timber held as an investment rather than as a trade or business is not subject to the passive loss rules, which sounds like a good thing, but deductibility of expenditures by non-corporate investors is more limited. For example, how are these expenses handled? Well, if you're an investor, management expenses plus other miscellaneous itemized deductions are deductible only to the extent they exceed 2% of adjusted gross income. This is another thing that was introduced in 1986, was this concept of the 2% of adjusted gross income floor. So anything that ends up as a miscellaneous itemized deduction, you have to subtract out 2% of your adjusted gross income. For example, if your adjusted gross income is $40,000, then you will have to deduct $800 out of all those aggregated expenses, and then only that which exceeds $800 can be deducted from your taxes. Anything that's used to reach that 2% floor is going to be lost for tax purposes. Productive during the tax year, and what do we mean by that? Well, we'll get into that in a minute, but now we're going to get into this. I'm going to get into it a little bit later. You do have the option of capitalizing these expenses. In other words, you put them on the account like John's gone over with, but then remember the theme that we've been trying to introduce here is you want to get your money back as soon as you can. Anything that you put on the book sits there until you have a timber sale. And $1 in my hand today is going to be worth about 96 cents this time next year, and you're going to have inflation eating away at it the longer it sits in the account. So, as a general good business rule, you want to recover your money as quickly as you can. Now, you can only do that in years in which your property is not productive. That is, when it is producing no income, such as from a hunting lease. If it's earning income from a hunting lease, you cannot capitalize those expenses. All right. Now, some of the other expenses are handled. Property and other taxes are deductible against income from any source, so that's a good thing. If you prefer, you can elect to capitalize property taxes and recover them on the sale of timber rather than deducting them in the year you pay them. Severance and yield taxes, however, may not be capitalized. Interest on indebtedness is deductible only to the extent of net investment income from all sources. So if you have expenses here and interest, He's got to have net investment income in order to deduct those expenses. But you can elect to capitalize all or part of the interest paid instead of deducting it or carrying it forward and use it to offset income realized from the sale of timber. And any excess of investment interest expenses over net investment income that cannot be deducted in a particular year can be carried forward indefinitely and be eligible for deduction in any later year in which net investment income from any investment source is realized. But again, this is an entanglement with this thing, because what you want to do is deduct these expenses against income from any source as soon as possible. Now, your deductible investment expenses are listed on Schedule A of Form 1040 on the appropriate line for deduction, and they're going to be down there in the miscellaneous itemized deductions on the back of Schedule A. However, you can only do this in years in which you itemize your deductions. If you don't itemize deductions, you don't have a way to write off these expenses because you're not going to be filling out Schedule A. If in any year you do not itemize deductions, or alternatively you do not elect to capitalize these expenses, then the costs are lost for tax purposes and you will not be able to recover them. So being an investor after 1986 was not a good thing. Prior to 1986, you could deduct those expenses on Schedule A under miscellaneous itemized deduction. There was no 2% floor. So that's the passive loss rule. We thought it was going to be a big bugbear, monster. The IRS was going to beat forest landowners over the head with it, and the IRS just really kind of gave a very liberal interpretation. And so now it's very easy for landowners to qualify to write off those expenses against income from any source. However, you've got to do it. And how do you signify to the IRS that you are materially participating? Well, you do it by filing Schedule C or Schedule F. And when you do Schedule C or Schedule F, you'll come down to about line, I want to say 3. It's somewhere in the top 10 lines. They'll say, did you materially participate? And you check yes or no. You want to check yes.